Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 141. And in this episode, we're reviewing the performance of the global markets during the first week of 2025. And that is from Monday, the 30th of December, 2024 to Friday, the 3rd of January, 2025. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. And we kick it off with a global overview from the World Bank, where according to the World Bank's Global Economic Prospects Report that was dated June 2024, the global economy is projected to grow at 2.6% in 2024, matching the growth rate recorded in 2023. This forecast marks a slight downward revision from the earlier projections, reflecting continued economic headwinds, particularly in the emerging markets. According to the World Bank, the Sub-Saharan economy is projected to grow at a moderate rate of 3% in 2024, which is 0.6% higher than the 2.4% growth recorded in 2023. Nevertheless, the risk of debt distress remains high, with more than half of the countries facing unsustainable debt burdens, as the region's public debt to GDP ratio is expected to remain high at around 57%. And from the World Bank review, we move over to Wall Street, where stocks rallied on Friday and closed on a higher note as the market recovered from a shaky start to the new year. Friday's rally was driven by tech stocks such as chip giant Nvidia, which rose 4.7%, and tech stocks could also benefit from the trend of increased spending on artificial intelligence, with Microsoft announcing on Friday that it would spend $80 billion on AI-enabled data centers in 2025. Friday's rally helped to snap a 5-day losing streak for the market, but it was not enough to move the three major indices into positive territory. The S&P 500 finished the week down 0.48% to close at 5,942, whilst the Dow Jones Industrial Average lost 0.6% to end the day at 42,732, and the tech-heavy Nasdaq Composite lost 0.5% to close the week at 19,621. A brief overview of the stock market in 2024 shows that the stock market rally in 2024 was spurred by interest rate cuts, economic growth, and artificial intelligence. Developments that helped to fuel the stock market rally in the second half of 2024 included the Federal Reserve cutting its benchmark interest rate by 100 basis points since September, which in turn boosted confidence that the U.S. economy could sustain its recent pace of economic growth. In addition to that, stocks also rallied sharply following the election of Donald Trump in November as traders cheered the prospect of lower taxes and a looser regulatory approach under his administration. For the full year 2024, the S&P 500 surged by 23.3%, whilst the Dow rose by 12.8%, and the Nasdaq outperformed with a gain of 28.6%. In the Treasury bond market, U.S. Treasury yields ticked up on Friday as investors considered the economic outlook for 2025 against a backdrop of a quiet trading session that was characterized by thin holiday trading volumes. The Treasury bond market is coming off a choppy year in 2024 as the yield on the benchmark 10-year Treasury bond started out 2024 below 3.9% before jumping to a high of 4.7% and then falling back down to below 3.7% before eventually ending the year at 4.5%. In December, the Federal Reserve lowered its policy rate by 25 basis points, but indicated that there would be fewer rate cuts in 2025. According to the CME FedWatch tool, the Fed Fund Futures is pricing in a hold in interest rates at the Fed's next policy meeting that is scheduled for the end of January 2025. Both benchmark yields were down for the week as the yield on the 10-year Treasury bond rose more than 2 basis points to close at 4.6%, whilst the yield on the 2-year Treasury note gained by 3 basis points to trade at 4.28%. And just for your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the commodity markets, the price of crude oil posted a weekly gain on Friday, underpinned by expectations of further economic stimulus in China and lower interest rates in the United States. China raised the wages of government workers in a one-off move that is expected to inject up to 20 billion shillings into the economy. Meanwhile, in the United States, further rate cuts by the Federal Reserve will lower the cost of borrowing and help to boost consumption and demand for oil. Traders are also following the weather forecast, which shows the likelihood of a cold snap in the United States and Europe that could boost demand for heating oil in the coming weeks. In response to the foregoing, the price of Brent crude gained about 3% for the week to close at $76.51 a barrel. Meanwhile, the price of the U.S. benchmark, that is West Texas Intermediate crude, added nearly 5% to settle at $73.96 per barrel. In the precious metals market, the price of gold retreated from a 3-week high on Friday, pressured by a stronger dollar, while markets braced for a potential shift in trade policy under the incoming presidency of Donald Trump. Trump's proposed trade tariffs are expected to fuel inflation, which could slow down the pace of U.S. rate cuts and consequently limit the upside for gold. After 3 rate cuts in 2024, the Federal Reserve projects only 2 rate cuts in 2025 due to persistent inflation. The price of spot gold was up about 1% for the week and closed off at $2,637 per ounce. For your information, gold thrives in a low interest rate environment because it does not provide a regular yield like a bond. In the cryptocurrency market, Bitcoin experienced a blistering rally in 2024, and crypto investors are convinced the flagship cryptocurrency will continue to hit new all-time highs in 2025. In December 2024, the world's largest cryptocurrency broke above the highly anticipated level of $100,000 and set a new record high above that price. This move came after Donald Trump, who ran on a pro-crypto platform, secured victory in the U.S. presidential elections in November. Trump's imminent return to the White House has boosted sentiment surrounding crypto, with many industry analysts expecting him to promote a more favorable regulatory environment for digital assets. We now change scene to the Kenyan financial market, and we start by looking at the cost of living in the country, where consumer prices in Kenya rose for the second consecutive month in December, driven by renewed pressure on the cost of food, transportation, and electricity. According to data released by the Kenya National Bureau of Statistics, the annual rate of inflation increased from 2.8% in November up to 3% in the month of December. Food inflation increased from 4.5% in November to 4.8% in December, whilst fuel inflation edged up marginally from negative 1.6% in November to negative 1% in December. Meanwhile, core inflation, also known as non-food, non-fuel inflation, this stabilized at 3.2% in December, reflecting the general stability in prices for most consumer products. And on Kenya's economic growth, according to the Kenya National Bureau of Statistics, the Kenyan economy recorded a growth of 4.6% in the second quarter of 2024, which was slower than the 5.6% growth recorded in the second quarter of 2023. And for the full year 2024, the Kenyan economy is projected to grow at an average rate of 5.3%, down from 5.6% in 2023. The slower growth is primarily driven by reduced private sector activity, plus the ongoing fiscal consolidation efforts by the government, which has limited public spending. Additionally, political instability fueled by public demonstrations has undermined investor confidence and disrupted economic activities, and in the process weighed down on economic growth. Moving over to the domestic foreign exchange market, during the past week, the Kenya shilling remained flat versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.31 compared to 129.30 that was recorded the previous week. Meanwhile, the sterling pound was priced at 162.20 and the euro was valued at 134.72. And on the regional front, one Kenyan shilling was changing hands for 28.45 Ugandan shillings and 18.75 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.65. The dollar-shilling exchange rate appears to be reverting back to its previous static rate of 129.20, where it was for about 2 months. This price action, where the dollar-shilling rate is trading within a very narrow range for a prolonged period of time, is both unrealistic and unsustainable. The central bank has previously stated that it does not have a target range for the dollar-shilling exchange rate and only intervenes when there is extreme volatility in the forex market. Based on that premise, the central bank should stay out of the domestic foreign exchange market and let the shilling find its optimum rate through demand and supply. That said, the long-term outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product, and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined marginally by just $3 million for a total of $9.198 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that has pushed the country to the precipice of a sovereign debt default. In the interbank market, the liquidity situation in the interbank market was sufficient to meet demand and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is a rate that banks lend to each other on an overnight basis, this declined by 3 basis points to 11.06%, down from 11.09% the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 25.1 billion shillings, down from 33.7 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 31.1 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 2nd of January, and the central bank received bids totaling 15.69 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 65%. And the results of the auction were as follows. The 91-day rate dipped by about 7 basis points to average out at 9.82%, whilst the 182-day rate was flat for the second week running at 10.02%. Meanwhile, the 364-day rate declined by 3.8 basis points to settle at 11.37%. In the Eurobond market, during the past year, the yields on Kenya's Eurobonds recorded a mixed performance, with the yield on the 13-year 2021 Eurobond increasing the most by 60 basis points as it rose from 9.5% in January 2024 to 10.1% in December 2024. Meanwhile, the yield on the 7-year 2019 Eurobond decreased the most by 160 basis points as it fell from 10.1% recorded at the beginning of the year to 8.5% at the end of 2024. At the Nairobi Securities Exchange, during the year, the equities market was on an upward trajectory, with the NSE 10 gaining the most by 42.9%, whilst the NSE 25 shot up by 42.5%, and the NSE increased by 34.3%, and last but not least, the NSE 20 was up by 33.3%. The stock market performance was driven by gains recorded by large cap stocks such as KCB Group, which recorded a life-changing increase of 89.5%, with Standard Chartered Bank coming in second with an equally massive gain of 74.6%. And in third place was Absa Bank, which managed to tip the scales with an increase of 56.3%. And then there was Diamond Trust Bank, Bamburi Cement, and East African Breweries, which also recorded respectable gains of 54.2%, 52.8%, and 51% respectively. This sterling performance was, however, weighed down marginally by losses recorded by other large cap stocks such as British American Tobacco, which declined by 11.5%. Up next is our topical issue, and this week we are looking at the economic outlook for Kenya in 2025. For most Kenyans, 2024 was a year characterized by economic hardships that were compounded by higher taxes and statutory deductions, which culminated in widespread protests that forced the government to withdraw the finance bill for 2024. Not surprisingly, the Kenyan economy grew at its slowest pace in 4 years, recording a growth rate of 4.6% in the second quarter of 2024, compared to a rate of 5.6% in the second quarter of 2023. And according to the Central Bank of Kenya, the economy is projected to record a full-year growth of about 5.1% in 2024, down from 5.6% in 2023. However, it was not all doom and gloom, as the annual rate of inflation fell significantly to a 17-year low of 2.7%, and that was in October 2024, and this was mainly driven lower by falling food and energy prices and offering much-needed relief to cash-strained households. On matters exchange, in February 2024, the Kenya shilling depreciated to an all-time low of 161 shillings versus the US dollar before recovering to end the year at 129.29. The initial depreciation to 161 shillings was mainly driven by fear of a potential sovereign default with regards to the repayment of the $2 billion Eurobond that was set to mature in June 2024. In contrast to the economy, 2024 was a good year for investors at the Nairobi Securities Exchange. Bonds continued to deliver double-digit returns for investors, with interest rates hitting a high of 18.5%, which was a reflection of the elevated interest rates that characterized the market for most of the year. The highest returns were, however, available from the stock market, where investor wealth, the bourse, grew by about 35%, which works out to a market capitalization of about 1.94 trillion shillings as at the end of 2024. Analysts predict that equities will continue to record a positive performance in 2025, but returns from government bonds are expected to decline in line with the ongoing reduction in interest rates. The only thing that is certain in life is a death and taxes, and this was especially true for Kenyans in 2024 when the contentious finance bill for 2024 was withdrawn following widespread protests that resulted in the death of about 60 Kenyans. Despite the withdrawal, the government has reintroduced a number of rejected clauses through the Tax Laws Amendment Act of 2024, which was signed into law on the 11th of December 2024. Additionally, the Budget Review and Outlook paper for 2024 has also outlined government plans to raise an additional 343 billion shillings in tax revenues for the fiscal year 2025-2026, signaling additional taxes and the risk of igniting a fresh round of social unrest. Meanwhile, the African Growth and Opportunity Act, better known as AGOA, which provides African countries with duty-free access to the U.S. markets, this expires in September 2025. A key stumbling block in the renewal of AGOA comes in the form of Donald Trump's trade policy of America First, as well as foreign policy disagreements between the United States and some of its AGOA partners. Another area of concern is the fact that the International Monetary Fund's 4-year funding program for Kenya is due to expire in April 2025. This brings to an end a funding line that has been Kenya's primary source of external borrowing since 2020. This program, which is under the Extended Credit Facility and the Extended Fund Facility, cannot be extended since Kenya is on track to exhaust its authorized access limit under the current program. There has, however, been some positive indications from the IMF about the possibility of setting up a new standby facility for Kenya in 2025. And finally, on the government-to-government fuel import deal that Kenya signed with 3 major oil companies from the Gulf region and which was set to lapse at the end of 2024, this has now been extended into 2025. Kenya signed the fuel import deal in April 2023 with a view to facilitating the importation of fuel on a credit basis of up to 180 days. The deal was meant to reduce the pressure on the dollar-shilling exchange rate by staggering the monthly demand of about $500 million that was required by local oil dealers under the previous open tender system. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, at the end of it all, you will not regret the things that you did, but rather the things that you could have done but did not do. Think about it. Thank you, and God bless.